Well, hey folks, you'll have seen that the natural gas price rallied yesterday after the storage report, and well, I'll show you some figures shortly showing that the storage report showed that the level of storage for this period of the year was the lowest it's been in the last 6 years. So a pretty significant number. We'll have a look at those numbers very quickly. But I put out a little tweet and a message to my subscribers, and I've put that up here for you to have a look at. And there are a few sort of 6 factors to go through, and then we'll have a look at the charts. But I want you to count mentally how many of these factors you think are bullish compared to how many might be bearish for the price of natural gas. So let's expand this view. And we'll go through the news on these very quickly. I'll just point out the articles so you can read them for yourself. First of all, the Australia strike, which seems to be going ahead. And Australia's export of gas accounts for about 6% of the total world consumption. So it's quite a large amount. And it's a higher percentage for the EU, I think around about 10%. So this is going to have a significant effect on natural gas supplies, of course, and it's going to have a bullish effect on the price. Naturally, as supply drops, the price is likely to respond accordingly and go up. And then the storage report, which I referred to earlier, was the lowest in the last 6 years. So we get this sort of twin peak, which is the next point here, where we get a bit of an accumulation in storage during the lead up to summer, sort of spring season. And during the summer, we get a drawdown, storage drops, and then into the fall, the storage increases, the amount that's in storage, and we get the second peak, and then a drawdown into the winter as we start using electricity and gas for cooling. So sort of approaching the dip between those two peaks, the midsummer peak and the midwinter peak, and we're approaching the dip, which is the fall period. But the amount in storage is actually lower than it's been for the last 6 years. And we've come from the hottest summer on record, apparently, ever recorded in Europe and in America, at the highest temperatures recorded, particularly in Europe, I believe, ever. So that's caused a drawdown on gas, and you can see that in the storage levels, of course, because the storage levels, not only in the US, but also in Europe, have come down. And remember, a lot of gas from America gets exported to Europe and other places like Japan, about 10 to 12%. So we've seen a drawdown with these hot temperatures in both the US and in Europe. So the question remains now is, what's this winter going to be like? And there are still rumors of this sort of Arctic supercell weather approaching during winter, coming up this winter. And once again, I'm not too sure how they're able to forecast these so far in advance, but there is this idea out there that there's going to be this supercell Arctic trough, or a series of them cavorting through the US and Europe this coming winter, which will drive demand higher on the back of already fragile supplies, with the Nord Stream pipeline being destroyed. We've got the Russia story with Europe increasing its take-up from Russia, which is a precarious situation, of course, but Europe seems to have increased their imports from Russia by about 40% since the beginning of the war in Ukraine. And they were expected to actually reduce take-up from Russia over this period, but they've actually increased it significantly. And of course, that's even though it seems like there's free flow of gas from Russia into Europe, and Europe's heavily dependent on natural gas, seems like that's a good situation. It could be negative for prices. In other words, there's a sufficient supply. But remember, it's a very precarious situation, and Russia's really got Europe by the so-called shortened curlies, and anything that goes on or goes wrong between Europe and Russia and the US and Ukraine and that whole boiling pot scenario is potentially very dangerous to the supply of natural gas, and that threat always looms. And then we've got the US dollar. We'll have to talk about the US dollar. I've put out some articles recently from Bloomberg and Reuters showing that there's an overall expectation that the US dollar is going to start to reduce in value in coming months, weeks, and possibly even years, which is going to place an upward price pressure on commodities in general, including natural gas. Now, a lot of people say, well, the dollar doesn't affect natural gas, but it does, because quite a lot of US natural, and we're talking about the US price, the Henry Hub price, quite a lot of natural gas, about 12% of it, gets exported from the US and sold in dollars. So if the US dollar drops in value against other currencies, then we're likely to see at least some sort of effect, an upward pressure on the price of gas. And then we're going to have a look at the charts. We've got this big 2.5 level, $2.50 on the charts, which we'll have a look at very closely now. I'll show you what the action was. I put up some tweets and some comments on it. There was enormous volume coming in at $2.50, and that level was so strongly defended. You rarely see this on charts, such a clean defense level, which we saw yesterday prior to the storage report. Now, perhaps the storage report numbers were leaked, being lower than expected and the lowest in the last 6 years, but nevertheless, that price level of $2.50 was incredibly well defended. And you can see that in the volume profile and the price action on the charts. So having said all of that, let's have a look at a couple of these things quickly. So I'm just going to run through a few of these things that I put up here on Twitter and in my private community. And this is the volume and price action chart at $2.50 that we saw yesterday. Look how well that level was defended, and we saw the price attacking that level on multiple occasions, just below $2.49 actually, and then these multiple small tiny reversal candles, big spikes down, spike up, another attempt to break through there, and a wick low there, wick low, lots of wick lows, and tiny reversal, you could call them morning star type candles, followed by this massive rally up after the storage report. And have a look at the volume here on the right hand side, the volume profile. You can see this massive amount of volume, and I presume not only buying but both buying and selling. It looks like that area was really under serious attack, and that there were traders, speculators, perhaps hedgers and funds, market makers, options market makers, etc., futures market makers and traders trying to push the level below there. So that volume not only represents very strong bullish buying pressure, but also the attempt to drive it lower. And you can see there was some quite good volume just below $2.50 as well. So, but mainly at $2.50, very bullish price action and a huge volume spike at that $2.50 level. And then the storage report drove the price up. I'm just going to switch across to my private discussion channel and a couple of notes here. And I pointed out that the storage report reflected the lowest level compared to the previous 6 consecutive years. And we can have a look at this chart here, which I'll just put up on the screen. And that level there of around about 32, which is what we got. If you compare it to the last, we can only see 5 years on here. This is a 5-year chart, but going back to 6 years ago, this level here is the lowest it's been by a considerable amount, by about 50%. So mostly we've been getting sort of 40 to 50 to 60 to 70, and on this occasion we were at 30. So a much lower figure compared to the last 6 years, even though it wasn't actually that much lower than what was expected. So very interesting. When you're looking at storage figures, don't only compare it to what the expected was and the previous number, but consider what was going on over the last number of years. And these are the twin peaks that I referred to earlier. So you'll see it's the same pattern every year during the springtime, when there's less demand for natural gas for heating and cooling and so on, particularly, I suppose, going into summer. And out of winter in spring, there's just general lack of demand. And then during the summer season, when there's cooling demand, you can see the storage levels or volumes drop. And then going into the autumn season, or the fall, as they would say in the US, the storage volume picks up again and then drops dramatically into the winter, where the most demand takes place for cooling. You can see it's the same every single year. And we get this twin peak scenario. There's the peak, trough, peak, peak, trough, peak, and it's the same every year. If you go back on these charts, you can go back about 20 years and it's the same every year. This year, however, the trough has been a bit deeper, and probably because of this very hot weather and also perhaps supply concerns and a lot of take up from places like Europe and Japan out of the US inventory. And so we've seen this level drop to the lowest it's been in 6 years. So that's an interesting factor to note. And then here's the article from Bloomberg about natural gas prices jumping as LNG workers begin long-awaited strikes. Impacted operations accounted for 7% of global supply in 2022. It's a very large amount. The Australians produce a lot of natural gas, and they use some of it themselves and put some of it into their cars. A lot of their cars, I think about 10% of their cars run on natural gas. But European prices jumped as much as 11% after talks broke down. And there's a big article on that on Bloomberg. Just going on to say liquefied natural gas workers at key Chevron core sites in Australia began partial strikes on Friday after talks failed to reach an agreement in a dispute that's rolled global gas markets. Benchmark gas futures in Europe as much as 11% on the news before pairing some of the gains, which highlights the market's vulnerability after last year's energy crisis. Partial strikes began at 1 p.m. in Perth, which accounted for 7% of global LNG supply last year. So a really big number. So for those of you wondering how this sort of seemingly smallish news about a strike in LNG workers in Australia affects the world gas price and the situation in supply, it's pretty significant. And there are a couple of other things I put up in my members' discussion related perhaps to the dollar. And there's an article here. The ECB may raise interest rates one last time to tame inflation, though economists are unsure if it'll happen next week. So that's their next meeting. Bloomberg survey shows an almost even split between those anticipating 10th straight hike on Thursday and those expecting a hawkish pause. Still below the US 5.25, but 4% is pretty high for Europe. And we're talking about the US dollar and what effect that'll have on natural gas prices. As I said earlier, if the dollar continues to strengthen, we should see some pressure, downward pressure on the price of natural gas. But if the dollar begins to weakness, and we'll have a very quick look at the dollar index chart shortly, the dollar starts to weaken, that will put an upward pressure on the price of natural gas too. So just going back to my notes here, so we've covered the Australian strike. About 10% of EU imports come from Australia, natural gas. Storage in the US was the lowest in 6 years. We talked about that. We talked about the Twin Peaks, the hottest summer on record, drawdown on stocks, on supply or storage, and then leading into this second peak, which will be the fall, and then winter, and whether we get these Arctic cells, Arctic freezing zones cavorting and careening across Europe and the US. We don't know if that's true or not, but they're still mumbling and murmuring about it. So I assume that the weather forecasters kind of know what they're talking about. And then we've got this Russian supply to Europe, 40% increase in Russian LNG going into Europe at the moment. And I've just talked about the precariousness of that situation. Plenty of natural gas available from Russia, but we've got this situation going on in the Ukraine. And the fact that Russia has such dominant hold over Europeans' natural gas supplies is pretty worrying. And if anything, even though there's an abundance of supply, I would suppose that's bullish for the price of natural gas. Whenever there's fear and doubt and worry, prices tend to go up. And then we talked about the US dollar. We'll have a look at the dollar index chart shortly. And then the bullish charts. We had a look at the 2.5 level and its defense. We had a look at the volume profile on that as well. So having said all of that, let's go and have a look at the charts, show you where we stand at the moment, and also tell you my positioning on natural gas. So let's go straight across there. Right, so here's the 4-hour chart, and you can see there's the movement that we saw, that the 2.5 level and the defense of that level that took place yesterday after the storage report. And actually, this is a 4-hour chart. So leading up to that storage report, we saw a full 24 hours of a dead stop at that 2.5 level, an absolute brick wall that it hit there. It couldn't get beyond there no matter what. Even though we saw there was huge volume taking place, we looked at that on the hourly chart, the price was not able to push down below 2.5 and held there. We took the opportunity of getting another piece in on natural gas, and I bought it around 253. So that puts me at 258 overall position at average price at $2.58. And I have a 75% position on natural gas now. So not quite fully loaded, but pretty close. So 75%, that's the biggest position that I've held for the last number of months in natural gas. And most of the time it's been around about 50%. But I'm able to get in with a pretty tight stop loss on that last piece, which is just below those lows, which were very strongly defended at $2.50. And we'll wait and see what happens. Since then, the price has moved up. We stalled a bit at around $2.60. Expectedly, that's the top of this gap. So the gap was filled on the downside, and we moved down, and we've moved back into that gap and filled it from the upside and just reached the top of the gap again. So sometimes these gaps actually play over and over and over again. And even though we broke and cleared the gap and filled the gap when we moved down, the gap's still playing a bit of a role on the way up. Because remember, the gap is simply a liquidity gap. It means there's no real price action, no real volume in that area. But at the top of the gap and the bottom of the gap, you see big volume areas, big levels of supply and demand. So at the top and the bottom of every gap, there's an area of significant supply and demand. You can see that's what we've hit here. It's also just below these two moving averages. So our position is 75% long, an average price of $2.58. It's actually $2.57 and some change. Let's just call it $2.58. And I have a stop loss on that last piece, that last 25% piece, just below $2.49. And the rest I've got a hedge on at $2.39 to hedge the entire balance of the rest of the trade, should we drop through 250 and down below this low here, which would take us down into the 239 level, which is where my hedges. So that's what that looks like on the 4-hour chart. We're aiming to get back into this gap here. This red block here is the gap that was left behind. When was that? On the 4th, on Monday. So we're now in Friday. So this gap was left behind on Monday. It'd be great if we could fill that up before the end of this week and get up to at least $2.74 or 75, the top of this gap. Let's go and have a look at the overall sort of daily chart on the Henry Hub. And well, you've seen this multiple times. This is the longer term channel going back to earlier in the year, middle of April really. And we've been trading beautifully within this channel so far. At some stage, this channel is going to break. Just remember that. And it could be to the upside, but it also could be to the downside. And we might have to see this channel line tested, broken, perhaps just broken temporarily, and a spike back up again, or we could see this price begin to move down. There was a time when we had a very similar piece of price action, and I can't remember how far back we have to go to have a look at it. Let's see if I can get it on a weekly chart, when we had something very similar to this big rally. We're on the weekly chart now. Yeah, so it was actually 2001. 2001 we rallied up to $10 and dropped off sharply, very similar to what we're seeing in the current price action. We came down to around about $2, which we did on this occasion too, rallied up to just above $3, $3.50, and then fell back down again towards the beginning of the following year. So actually the price fell during the winter season, which is interesting. That's the season we're approaching right now. So we got from $2 up to $3.50 and then fell right back down to $2 again and made a double bottom there. If we scoot back to where we are at the moment, you'll see the similarity. I'm not saying this is what's going to happen, but there we've come down from $10, exactly the same, all the way down to $2. We rallied up not quite to $3.50, but we got to $3. And if you follow this on from what we saw in 2001, the price then dropped down during the winter, retested $2, made a double bottom and rallied back up again. Now, whether that's going to happen or not, I don't know. I don't think so. I think there are enough bullish factors when considering everything that we looked at earlier in the video to convince me that natural gas is probably going to go to $3.50 at least. And that would take us up to that area where the price fell back down in 2001 and retested the $2 low. Now that's possible. I think we might get up to $3.20 or $3.50 first. If that scenario is going to play out, then a retest of $2 and then a continued move higher. I don't know which one of those is going to happen, but for the moment, if we switch back to the day chart, we're still trading within this channel and it still looks pretty good. And we want to get up to that gap up there. Let's just zoom in on that. That's that gap that was left behind on Monday. And the top of that gap is at around about $2.75, somewhere around there. So that's a liquidity gap. That's where the last major level of supply will be. And then we can get through that gap, just slice through there, up into this next level of supply, which would be at 275, 277, somewhere around there. And if we can bust up through there, then our path's clear up to about $3. Not quite clear. There are various bits and pieces along the way. But generally, if we can get above there, above $2.80, $2.85, we're pretty clear on our path back up to $3. But I think then we'll have another go at the top of the channel that would take us up to about $3.15 or $3.20. So that's the overall picture. And until we actually complete that and get up there and bust through, first of all, this gap, then this high above the gap, and then the sort of quiet zone, low liquidity zone up to $3, and then eventually bust through $3 to $3.15 or 20, I think we could see quite a sharp correction from there. So that's the way it looks at the moment for natural gas, and so far so good. We just hope that this doesn't fall back down today, but we have broken above the highs from the last couple of days, these two spikes. We're holding above there for the moment. Let's just zoom in and have a look at that. And we've also broken above the 20-period moving average, which is always good. And that's the first sign of any bullishness. But if I just draw a horizontal line above those two highs there, you can see this last 4-hour candle just prior to this current one broke up through those two highs. That was potentially a double top type formation. And we're still holding above there, and we haven't broken back down. So just on a micro perspective, this looks pretty strong so far. Remembering we've got the 50 and the 200 period moving averages above us on this 4-hour chart, and then the gap, this red blob here above us in the chart. If we can get to the bottom of that gap and into the gap, we should slice up to $2.75 pretty quickly. If we can hold that $2.75 level, and I think the $3 level is more likely than not. And then once we get to $3, $3.15, $3.20 before a pullback down to at least $3, probably back down to $2.75 after that. So that's the overall picture for natural gas. You've had a look at all my various bits and pieces of commentary. It's been a bit mixed up and jiggled around, but I hope you sort of got the gist of it. And I think if you weigh up for yourself, I'm not saying I'm right, but if I look at all of those 6 factors that we started the beginning of the video with, to me it looks pretty bullish. I did say we'd look at the dollar index just to finish off, but this is the dollar index at the moment, and we've had this very long rally up. Now, if I put this on a weekly chart, it's a bit easier to see. We've had 1, 2, 3, 4, 5, 6, 7. This is the 8th straight week in a row that the price has moved higher. Once you get to 9 weeks, it's very unusual for a movement to continue one way with higher highs and higher lows. To see more than 9 bullish candles in a row is unlikely. This level here at around about 105 and up to 105.60 is a very, very key resistance level. And if we have a look at this going back a very long time, in fact, if I put this on a monthly chart, let's see if we can do that. This is a super key level right where we are at the moment. You can see it's been resistance and support on multiple occasions, and that's where we are at the moment. Going back to the day chart, you can see we're just trying to top out there. We could get a little higher, perhaps make a ninth higher week. Not too sure. We could get up into this zone a little bit higher. But so far, there's no indication that we're going to move higher or that we're going to come down. We've just got this sort of hesitation daily candle as far as it's formed today. Yesterday was still a bullish candle with a higher high and a higher low. No wick tops, nothing to indicate a reversal. So we'll have to see how that plays out. It is Friday. Sometimes Fridays are free fall Fridays. I want to point out one more thing whilst we're talking about the dollar index. And I did put this article up on my members channel and on the YouTube members community. And if you'd like to join that, at $7 a month, you can click on the join button below this video and you'll get access to extra videos that I make on YouTube for members and also articles that I post and so on. And I put an article up yesterday about the US dollar. This is one of the Bloomberg opinion articles by John Authers, and he's talking about the dollar and the fact that we may see the dollar begin to fall, and along with it, the yen strengthen. So if you're interested in trading the yen pairs, it's a really, really important and interesting article. But talking about the US dollar, and the article covers tech stocks and US dollar and so on, various other things. But the hypothesis here, or the idea, the thesis, is that the US dollar has probably reached as high as it's going to go in the medium to short term. If that does happen, we should see a positive impact on the price of commodities. Well, I hope you enjoyed all of that. It's been a little long, but I hope you found it useful. And if you have enjoyed it, please consider subscribing to this channel if you're not already. And give this video a thumbs up and share it with your friends if you have any, and that would be much appreciated. Have a great day. It's Friday, and the Rugby World Cup, France versus New Zealand, starts today, a little bit later on. It's going to be exciting. Could be the opening game to the World Cup and also the closing final game if both of those countries have their own way. I have a different idea. I think the Springboks, the South Africans, are going to win. Have a great weekend and a great trading day. I'll speak to you next time.